Redfin, a real estate brokerage, has stated that many home buyers are on the sidelines based on the 7% interest rates that is looming shortly. Redfin's home buyer demand index dropped 1% a week ago. This is the first decline of a month full of increases. Also, mortgage purchase applications dropped by over 6%. With low inventory taking place in the housing market, it's also affecting sellers who, at this point where they're getting closer to renewal, have interest rates much lower than the 6% that's currently taking place, making it a lot more harder for them to afford the same loan for their property. Although the decline in new listings in December, it is still 17% lower than what it was back in February of 2022. And asking prices were at their lowest point, with reaching over 1.2% year over year. And the recent hike in the mortgage interest rates in the US is based on more of the inflation report that was taking place, giving the Federal Reserve the opportunity to increase rates based on the much higher inflation rate taking place in order to ease inflation. Inflation is cooling down very slowly, but with the strong job market and retail sales, it should give an opportunity for the Federal Reserve to ease up on the rates. It is unlikely that rates will drop in the next coming months. Also, it doesn't mean that interest rates will go up to about 7% in the United States. This is a reminder that the housing market is going through a difficult, challenging time, but like in other recessions that have taken place, we're going to see the economy increase, we're going to see rates drop, and we're going to see inflation drop, overall helping the economy as a whole. And with the market being where it's at, it does show that home buyers are a little bit more likely to get off the sidelines than what they were a couple of months back, showing a little bit of optimism in that right. Redfin's demand index is up 17%, which is fantastic considering where things were when interest rates were close to 7%. Pending home sales are improving, even though we're looking at an 18% decrease over a year ago, but definitely much better than we saw in November, where it was at 33%. Homes priced correctly are more likely to sell, and we did see buyers recently slowly back off because the interest rates were slowly starting to creep up towards that 7% rate in the United States. Since the pandemic, many home buyers were very sensitive as to how everything was taking place. When interest rates were low, we had a lot of home buyers maxing out as much credit as they personally could, and then once February, March came around the corner of 2022, these became a lot more challenging and put a lot more financial stress into the individuals who had a variable mortgage rate, and especially now for individuals looking to renew their mortgage. So as we've seen, interest rates are a very strong factor in terms of sensitivity, in terms of appreciation that the amount of home buyers can accept based on the times we're going through. Remember, this is a great time for any investor to get in the market with high rental rates and lower prices, but at the same time, if you're a home buyer as well, there's going to be less competition, and when the market rebounds, you're going to see a good amount of appreciation like we did in the last couple of years. Now, if you're someone looking for a short-term gain, it's not going to be the time right now. You may have to stick it out until you start seeing interest rates drop, seeing the interest rate on your payments drop on your mortgage, and be able to see appreciation equity continue to grow in your portfolio, or appreciation grow on your own personal primary residence. So it's going to be a little challenging now, but I'm telling you, in the very near future, we'll be able to get out of this. Rates will drop, economy will improve, vacancy rates, unemployment rates will continue to drop, overall helping the economy and helping any home buyers getting in now, as well as investors building their portfolio. All in all, for buyers, if they're able to afford the payments right now, considering how high interest rates have gone, and if we see in the very near future things head down to where we were before, about 4%, 3%, it's going to be a much better situation for any investors or anyone owning a primary residence. It'll be a lot more easier to afford. And especially for Canadians, in terms of the stress test that's taking place and becoming more and more difficult to qualify. If you're able to handle it now during this tough storm, you'll be in much better circumstance in the future when things drop and the economy recovers as a whole. Something to keep in mind, the average 30-year fixed mortgage rate in the US is at about 6.2% right now. Purchase applications were down in the United States over 43% from a year ago. Google Home searches are up about 35%, but is still considerably lower, about 24% lower than what it was a year ago. Here's some key housing market data in US metro areas. The median home price in the US was over $346,000, up over 1% from a year earlier. Median home prices fell over 20% in the top 50 populous areas in the US. Places like Oakland, Sacramento, Detroit, Austin, those are some of the markets that, based on their high populace, we saw a decrease in the median housing price in those areas. The median asking price of newly listed homes was $378,000, up 1.2%. The median housing price of newly listed homes was at $378,000, up 1.2% from a year earlier. And the average monthly mortgage payment of median homes was over $2,400 a month for their mortgage. And this is looking at rates of 6.32% in the United States. And rates are up over 24% than the $471 on their mortgage than what they were a year earlier. And pending home sales are down 70.6% from a year ago. And new listings of home for sale in larger populous areas in the US was actually down about 17% year over year, with the largest decline going to Sacramento with over 38%. Currently, the month of housing supply is a combined total of 4.1 months worth of combined inventory on the market. 44% of homes under contract had an accepted offer within 2 weeks being on the market. This is the highest since June, but still 52% lower than a year prior. And 21% of homes on the market sold above their asking price, but still 40% less than what it was a year earlier. The average sale to list ratio has actually gone down to 97%, which essentially means that the home seller got 97% of what they were anticipating, where back early in the pandemic, we were seeing numbers at times of over 105% of what they had originally listed the property for, and at times even higher. All in all, there's a lot of factors taking place in the market, especially in the United States, with their interest rates still rising, the economy still recovering, still many issues in supply chain, as well as building material costs, inflation, everything as such, making it more and more challenging. But once again, like we said before, it's still a great opportunity to get in the market if you can afford to do so, to grow your portfolio, to purchase your first rental, whichever it may be, or even to get into your first property. Because if you can afford the rates now, it's going to be more affordable in the near future when rates continue to slowly drop back with inflation and everything taking place as a whole. I hope this video is super helpful and insightful and gives you everything that you need to know about the market in the United States and what can anticipate in the very near future. I'm Josh Tavares, investor and realtor with eXp Realty Brokers. It'd be so great if you can help us out and hit the like button, hit the subscribe button, and even hit the notification bell to get updates on our newly uploaded content. Thanks so much for watching. Take care.